Good afternoon, everyone. My name is Chris Mafarage, and I'm a member of the Financial Services Executive Committee. The Federalist Society's practice groups cover a wide range of issues, including, obviously, financial services, and we're very proud to offer this amazing panel today. The practice groups are an excellent opportunity to engage on relevant legal and policy issues, and should anyone be interested in participating, please contact Nate Kazmarek. Today's panel features several fantastic speakers and is moderated by Judge Larsen. Judge Larsen sits on the U.S. Court of Appeals on the Sixth Circuit, and before that, Judge Larsen was a justice on the Michigan Supreme Court, a member of the University of Michigan Law School faculty, and previously clerk for Justice Scalia. Please join me in welcoming this esteemed panel.
Thank you, Chris. For those of you who are regulars in the Financial Services Practice Group, and those of you who are participants or close observers of the field, you know that today's topic is on the cutting edge and is of real importance to the financial sector. But I think it's also incredibly important to those of us who aren't financial professionals. That is, anyone who is just an ordinary participant in the US economy. Maybe you like to buy things, or sell things, or get paid, or store value. I fall into that latter category, an interested consumer, but not an expert on the financial sector. And so I will preface these remarks by saying that before I was asked to moderate this panel, I'm pretty sure I didn't know what a CBDC was. Now, such ignorance of changes in our digital landscape may not be completely unprecedented. You can just ask my kids about that. You can chalk that up to age or maybe the fact that as a federal judge, we're relatively cloistered and insulated. But on this one, I feel that I may not be completely alone. And my support for that comes from a conversation that I had with a young student just a few days ago, who upon learning that today's topic was CBDCs, asked with all sincerity why we were holding a panel on weed. So, with that in mind, we are lucky to have in our lineup today Randy Quarles, who will kick us off by explaining the phenomenon of central bank digital currencies and why we should be paying attention to that topic. Mr. Quarles is the chairman and co-founder of the Cynosure Group. He also has a long history of public service. Notably, he served from 2017 to 2021 as the vice chairman of the Federal Reserve and the system's first vice chairman for supervision, charged specifically with ensuring the stability of the financial sector. After Mr. Quarles sets the table for us, we'll hear from Professor Stephen Schwarcz. Professor Schwarcz is the Stanley A. Starr Distinguished Professor of Law and Business at Duke University Law School, and he's also the founding director of Duke's Global Financial Markets Center. His research and scholarship centers on insolvency and bankruptcy law, international finance, capital markets, systemic risk, corporate governance, and commercial law. And then we will hear, and Professor Schwarcz, I think, plans to tell us why he thinks that the United States adoption of a CBDC is inevitable. As a counterpoint, we will again hear from Mr. Quarles, who will offer his perspective on why he thinks a US CBDC is actually unlikely. And then we will hear from Professor Todd Zywicki. Professor Zywicki is the George Mason University Foundation Professor of Law at the Antonin Scalia Law School, and he is also the former chair of the CFPB Taskforce on Federal Consumer Financial Law. He researches and writes in the areas of bankruptcy, consumer credit and lending, consumer protection, and law and economics. And Professor Zywicki, as I understand it, plans to scare us a little bit by talking about how the adoption of a CBDC could be used by government as a tool in the culture wars. So we will start with opening statements from these three distinguished experts, and then we'll allow some time for back and forth, and then we'll open the floor to the audience for questions. I do want to note that Professor Schwarcz has another engagement, so he will have to leave us a bit early. So when he gets up to leave, rest assured, it is not anything that one of us said. All right, first up, we'll hear from Randy Quarles.
Super, thank you. Thanks, and I'm going to try to make, since I was given the task of giving an overview of the topic, I'm going to try to make this relatively dispassionate, although I may not succeed because it is my strong wish that, Judge Larsen, you didn't know what a CBDC was before this panel, and I'm hopeful that you can forget what it was shortly afterwards. So the Bank for International Settlements, the gnomes of Zurich or Basel, have defined a central bank digital currency as a digital payment instrument denominated in the national unit of account that is a direct liability of the central bank. So those of you who aren't up to your elbows in the entrails of this issue might be forgiven for wondering, don't we have that already? Because the general public already transacts mostly in digital dollars by sending and receiving electronic balances in our commercial bank accounts. These digital dollars aren't a central bank digital currency because they're liabilities of commercial banks rather than the Federal Reserve, but those digital dollars are insured by the FDIC up to $250,000, and that's virtually all retail accounts in the United States, which means that they are essentially as sound as a central bank liability. And the Federal Reserve also provides digital dollars directly to financial institutions, commercial banks, certain other financial institutions, and the federal law allows those financial institutions to have accounts at the Fed and receive payment services from the Fed, and those accounts, like your accounts at a commercial bank, are electronic. They're represented by bits and bytes on a Federal Reserve computer. So given the existing digitization of the US dollar, which is virtually total, the only Federal Reserve liabilities that you hold are the little pieces of paper in your pocket, which most of us use only for paying tips. There's no other use for them. How would a CBDC differ from the digital dollars that we use today? The key distinction is that when most people speculate about a Federal Reserve central bank digital currency, they assume that it would be available to the general public directly from the central bank. And you could imagine two different types of CBDC, two different ways of making this liability directly available to the general public. One is an account-based model, just as we have accounts with the country's financial institutions, their banks. We would provide individual accounts directly to the general public. Sorry, it's been almost a year and I still said we. But the Fed would provide individual accounts directly to the general public. An account holder with the Fed would send and receive funds by debit or credit to the Federal Reserve account in the same way as you do with your account at JP Morgan. A different CBDC model could involve a CBDC that is not maintained in Federal Reserve accounts, but is a little bit more like the pieces of paper in your pocket. Like cash, it would represent a claim on the Federal Reserve. Theoretically, that little green piece of paper is something that you can take to the Federal Reserve, and once in my lifetime, as I look around in the lifetimes of some people here, but not others, you could actually get something for it when you took to the Federal Reserve. Now, if you present it to the Federal Reserve, they will give you another green piece of paper. But it is theoretically a claim on the Fed, and it could potentially be transferred from person to person, like a banknote, or through intermediaries. Now, in thinking about, so why would you change the current form of the digital dollar to a central bank digital currency, we have to acknowledge that our existing system for transferring money around the world is, to use the technical jargon of the Federal Reserve, crappy. It is slow, it is expensive, it's kludgy, which not only contributes to its being slow and expensive, but also to its being unreliable. It breaks down far more often than it should. Now, for the most part, these issues have been solved for making purchases digitally. So you can track down a rare art print in Japan on the internet, you can buy it with a credit card, and you can have it hanging on your wall in Salt Lake City tomorrow. But if you're sitting in London with $1,000 in cash, and you want to send it to a friend in Paris, it doesn't matter if you are His Majesty's Chancellor of the Exchequer, that transaction is an Orwellian nightmare. You have to pay to change the dollars into pounds. You have to deposit them into your British bank account, first proving who you are. You have to find out your friend's bank account information. You have to wire the pounds to your friend's account. The receiving bank has to exchange the pounds for dollars, probably first exchanging them for euros, depending on the size of the bank, and the bank will then disperse the dollars to your friend after he proves who he is. You will be lucky if you can get that done for $150. It would not be shocking if it cost $250, and the process will take about a week to complete. And I know it doesn't matter if you are the Chancellor of the Exchequer, because I got that war story from Philip Hammond, who was, at the time, the Chancellor of the Exchequer. So the financial institutions and governments of the world have known that this is an inexcusable problem for a long time, falling especially heavily on the poorest citizens of advanced countries who are often remitting small cash payments to their families abroad. But hey, what can you do? We'll get around to it. Various obscure but important nodes of the international financial ganglia, such as the Committee on Payments and Markets Infrastructure of the BIS in Basel, or the Payments Working Group of the Financial Stability Board of the Group of 20, have earnestly been producing white papers and workshops and roundtables and almost everything but progress for what seems like much of my now long lifetime. So that is the background for a central bank digital currency. There has been a development in the nature of payments technology, largely driven by the private sector over the last few years, that can in fact make those sorts of transactions, sending cash in any denomination from London to Paris, almost instant and almost costless. Now, up to now, that technology has been being developed in the private sector, and the governments of the world have said, shouldn't we make our own state money able to do that? So that is the outline of the central bank digital currency issue. I have views about it that I'll express when it's my turn, but I tried to make that as dispassionate as possible.
All right, thank you. I think we'll now turn to Professor Schwarcz for his opening remarks, and then we'll go back to you, Randy, for your response.
Okay. Is this working?
Yep.
Yes, good. So a central bank digital currency really has various definitions and various concepts. And when I argue that a central bank digital currency is inevitable, I'm talking about something that would be competitive with what else is out there. And there are two different lines of competition. In China, for example, the People's Bank of China is in the process of implementing its own central bank digital currency. Not all the details about it are clear, but it appears to have both what I'll call an account-based and a token-based characteristics. And there is concern that if the Chinese CBDC gains purchase, that could, at least to some extent, undermine the position of the dollar as the world's reserve currency. Secondly, there are many attempts, some failed, some ongoing, to develop what's called a stable coin, or especially if used worldwide, a global stablecoin. And a stablecoin of this sort would be essentially sponsored by the private sector. It can be, it could be government sponsored, but it's likely sponsored by the private sector. And it would be in the form of a so-called cryptocurrency, which simply means that its transfer and ownership would be protected by cryptography. That it would be, you couldn't hack into it, or at least it would be hard to hack into that information. And a stablecoin is radically different than things like Bitcoin. Bitcoin is not going to be used as a general currency because it doesn't have a stable value, which you need. A stablecoin is one that is backed by some asset that is valuable and highly liquid. A good example would be a government's fiat currency. A US dollar would be an ideal so-called underlying reference asset. And there are various attempts, and they will be ongoing, to develop these stablecoins. So you have the competition, and the Fed and the US Treasury are considering how do we attempt to at least respond. And I think there are some practical answers. We, for decades, have had a digital currency. And this is the currency that occurs when there are wire transfers, Fed wire and so forth. And the regulation is governed by Article 4A of the Uniform Commercial Code, or UCC. And the goal, I think, now could be to try to adapt that digital currency, which is primarily used for so-called wholesale transfers among companies, financial institutions, and so forth, to adapt that to a retail currency. And I think that can be done without giving the Fed vast new powers. It can be done without potentially implementing a comprehensive government social credit system. The Fed can simply arrange to delegate, in the form of private ordering, its authority to the private sector, to the same commercial banks that currently engage in wire transfers. And I think this could be done extremely simply, extremely costlessly. It would involve consideration of what additional laws might be needed to govern it. You do have privacy laws governing the transfers of the wholesale wire transfer system. You don't have consumer protection laws, and I could talk about how they might work. Also, you have certain laws like anti-money laundering, AML, and know your customer, KYC, and these laws can be adapted, I should say, for retail customers. There are some interesting things about that, and when we have more time, I'll be happy to discuss it. The only other thing I should point out now, and I'd be happy to talk a lot more, is for a central bank digital currency, I think there are two basic formats that can be used. And Randy has sort of, mentioned these, but let me be more concrete. One would be account-based, and I'm proposing, at least initially, an account-based system because that is how Article 4A, or at least wholesale wire transfers currently work. The other could be so-called token-based. And token is just a nonsense name for a cryptographically evidenced, unit of currency. Different countries are considering different approaches. The EU, for example, is considering more of a token-based CBDC. The Chinese system is a combination of both account-based and token-based. And again, I think in the US, the simplest transition would simply be to expand, to delegate the authority from the Fed to the commercial banking system. And this private ordering could be very significant in terms of protecting the financial system. One of the great concerns of a CBDC is, are you going to disintermediate the commercial banking system? Will people stop putting money in banks and basically put money in the CBDC? And if you do that, you can actually undermine the low-cost business funding. And so the account-based, where you delegate to the commercial banking sector, would not cause that disruption. So I probably said too much, and I'm going to defer now to Randy to refute everything I said.
So I'm not sure. I'm not sure I'll refute everything you said, because it won't surprise you to hear that we agree on a lot. I think it's useful now that I'm in the mode of expressing my views as opposed to trying to express an overview. I mean, to trace the eruption of activity that there currently is around central bank digital currencies, and you can do that to two concrete events in the summer of 2019. First, in June of 2019, Facebook announced that it was developing a new stablecoin, as Professor Schwarcz described, called Libra. And a month later, the People's Bank of China announced that it would rapidly develop and implement a state-sponsored digital currency. And in response to those two revelations, the central banks and finance ministries of the world lost their minds. I spent that summer in international meetings of the G7 and the G20 in which more than one finance minister announced passionately that only the state may issue money. Bruno Le Maire, who was the French finance minister, was like Gandalf facing the Balrog, striking his staff against the ground and stating in majestic tones to Facebook, "You shall not pass." In the United States, there was a separate concern that a Chinese state-backed digital currency would be able to supplant the dollar as the global reserve currency, and those two catalysts have spurred a torrent of activity over the course of the last 2 years. Before those two events, all of the issues we've been talking about, the pros and cons of a central bank digital currency, were all equally evident, and no one was interested in the topic except the Swedes, who were accepted at the conclaves of central bankers in Basel the way you accept your eccentric uncle at Thanksgiving, who will sometime before the end of the evening begin talking about the time he was a teenager and saw the UFO. You love him, we loved the Swedes, but no one was taking this issue seriously until those two events. Now, not to put too fine a point on it, these are terrible reasons for the world's central banks, and especially the Fed, to jump headlong into the highly complex world of digital currencies. To begin with, as we have talked about at the outset, the notion that only the state may issue money and that the issuance of money by a private company is a threat to national sovereignty is puzzling to the point of incoherence. Almost all the money in the world is private money. It is claims on commercial banks. The only money you have that's issued by the Federal Reserve is the money you use to pay tips, and now I understand people are doing that with Venmo. I can never figure out how to do that. It takes me 20 minutes to tip with Venmo, so I still use the cash, but that's the only use I have for it. So the issuance of money by private companies through digital mechanisms like stablecoins is a new technology, but it is hardly a new concept. Governments of the world do have an interest in ensuring the stability of the structures through which such new private monies are issued, just as they have an interest in ensuring the stability of the institutions that issue bank deposits. But such regulation is perfectly possible to craft, and when properly regulated, stablecoins such as Facebook's or the myriad other stablecoins that are out there in the world would pose no threat to national sovereignty or monetary policy, and it makes no more sense for the government to seek to compete with them or to compete them away than for us to try to use our physical currency to compete away the banking system. Second, fears of China overtaking the United States as the provider of the principal global reserve currency simply because China has adopted a CBDC are like many of the ideas that our dear friends, the national security folks, bring with them when they stray into the world of economics and finance, endearingly simple-minded. The strength of the United States dollar rests on many factors. The dynamism and size of the US economy, our vast trade linkages throughout the world, deep financial markets, political stability, strong law and property rights, the ease of exchange and conversion, the presence of a credible monetary policy, at least up until the last little bit. None of these factors is going to be threatened anytime soon by a foreign currency. Any foreign currency, certainly not, because that foreign currency is in tokenized digital form. It would be like saying the Chinese have started printing the renminbi on purple paper and we're still using green, and we've got to catch up. Now, recently, I think realizing that after 10 minutes thought, those reasons for adopting a CBDC are not actually that compelling, the central banks of the world seem to be settling upon a third reason, which is there are 94 central banks of the world that are currently in the process of either considering seriously or implementing a central bank digital currency, and the United States will be forced by circumstances to follow suit. Well, our oldest son is 23 years old. And our youngest child, who's a daughter, is 18, just turned 18 a few months ago. She started college. You do the math, that means that we are wrapping up about a decade of raising teenagers. So I am familiar with the argument that everyone else is doing it, so I have to too. It's just one I'm used to hearing from children in inappropriate clothing and not from the world's central banks. So you might then say, okay, maybe there aren't any good reasons for adopting a CBDC, but so what? It sounds kind of fun and future-y. They promised us jetpacks and flying cars, and none of that happened. Isn't this the least they could do? What could it hurt? Well, the answer is that it could hurt a lot. I'm going to focus on only, in these opening remarks, on only one way in which that I think that it could hurt, although it's pretty big, and Professor Schwarcz referred to it, which is the inevitable at least partial disintermediation of the banking system, depending on how the CBDC is structured. If you can hold a significant part of your cash reserves in a absolutely riskless liability of the central bank, and the friction of using that cash for the various uses in which you would use cash has been significantly reduced by making it effectively the equivalent of a private sector stablecoin. It is inevitable that a certain portion of what is currently the deposit base of the banking system will move into that instrument. That's inevitable. The economists at the European Central Bank, as Professor Schwarcz said, they're very concerned about this topic, so they're trying to create a structure that will limit the disintermediation of the private sector banking system. They will absolutely adopt a central bank digital currency, but they're trying to do it in a way that avoids this problem. And their estimate is that with the best will in the world, keeping it as a very high priority, you will still get about 12 to 20% of the deposits currently in the banking system swept into a central bank digital currency, whether that's account-based or token-based. Now, that's not the end of the banking system, but it is a significant material transfer, and it would be a significant reduction in the capacity of the banking system to provide financial support to the real economy, which is the purpose of the banking system, unless those funds are re-intermediated in some way. Now, or unless that lending is done in some other way. Now, the lending could be done by the central bank. There are people who, for political, their vision of a well-functioning financial system involves a significant amount of government intervention. So the central bank could do that lending, but that will certainly be politicized. The Congress will absolutely want a say in to whom and on what terms the central bank makes those loans. Or the central bank can give the money back to the private sector banking system for them to do the allocation. but there is no political system known to man that will allow that transfer to happen without attaching strings to the transfer. You simply, now, again, people can have different views. I expect there aren't a lot of differing views in this room about whether that's a good thing or a bad thing, but it is, I believe, an inevitable thing, and we are slouching towards that outcome with the implications being disguised as whether or not we will have a cool new gadget. And that concerns me deeply.
All right, thank you. Professor Zywicki.
All right. Well, unfortunately, I think I agree with the idea that it's inevitable, but I don't think that's necessarily a good thing. There are really two layers going on here, the one that people talk about and the layer that's actually going on. So let's talk about the layer that people talk about, which is a fascinating intellectual discussion. And I'm going to focus primarily on the idea of retail central bank digital currency, right? Basically, consumers being able to access accounts, that sort of thing, what I think Steve called account-based central bank digital currency. And there's some fascinating discussions we could have, right? One of the arguments that's been made is that it would make it easier for central banks to do monetary policy, right? To manipulate the economy in a crisis. And their dream that they've dreamed about is negative interest rates to get us out of recessions and that sort of thing. I think what that really proves is the whole idea of a central bank is moronic, which is to say, it's never been obvious to me why, if we don't know what the proper price of pantyhose should be in the economy, why we think we know the proper price of money for the entire economy. The idea that the biggest problem we have with our economy is that the Fed doesn't have enough ability to manipulate the economy, I think has been proven again and again to be incorrect. So. But that's an interesting debate, right, that we could have. There's also arguments that could be made. This might be able to be better to help us track crime, human trafficking, smuggling, all this sort of stuff, right? That the government might give more ability to keep bad things from happening if they could monitor what people are doing, right? We all know that. Another argument, this could help with financial inclusion. And so, for example, if we have another crisis, the government could just make deposits directly into your bank account rather than sending out checks and all the things that they needed to do, right? And I think is for the reasons that Randy laid out at the beginning. The financial inclusion argument I think is pretty silly, which is people have access to plenty of consumer retail payments now if they want it, Venmo, bank accounts. Most of the obstacles at this point are created by government regulation, like the Durbin Amendment and Dodd-Frank and that sort of thing. People have all kind of ways they can get access to electronic payments if that's what they want for purposes of retail purchases. So all three of those are interesting discussions, and in a sane world, those are the discussions we should be having. What is the pros and cons of giving the government more control over manipulating the money supply or to track crime and financial inclusion? But that's not really why there's 200 people in this room, is there? Which is what this is really about, is the idea of programmable digital central bank digital currency that the government can control. And I've given a bunch of good reasons why that might be a useful thing for the government to be able to do. How many people in this room trust the government with the ability to program your money and to determine when and how you can spend it? Right? That's what this is about, right? That's what this is about, this is the final frontier. I am here today because last year in this room, I talked about cancel culture in banking. And one of my colleagues on the panel, my interlocutor, said, well, it's all, it's just, Zywicki's just hysterical. Zywicki's like concerned that this is going to happen. It's really just about the Nazis, right? Nothing's really happening to people, right? Well, the week after I spoke in this room, a payment provider shut off access to a nonprofit group in Missouri that was hosting a speech by Donald Trump Jr. saying that they wouldn't provide payment services for people promulgating hate speech. In January last year, Mike Lindell, the MyPillow guy, got all of his bank accounts canceled by his bank account because of his associations with Trump. And then in February, I think it was, we saw what Justin Trudeau did with the truckers in Canada, which is basically on the basis of people creating a disturbance, disturbing the peace and trespassing. They froze all of their bank accounts, right? Just keep in mind, that's what Martin Luther King was charged with, right? Creating a disturbance and trespassing, blocking traffic and things like that, right? Now, then they went beyond that. So after they froze their bank accounts, people tried to support the truckers using cryptocurrency. So what did the government of Canada do? They went to the crypto wallet people and said, we're freezing all of these crypto wallets, right? Now, here's the thing, folks. According to the poll taken at that time, 66% of Democrats in this country supported what Trudeau did in Canada. Right? Here's another piece of data for you. 59% of Democrats last January 2022, supported a policy that people who did not get COVID vaccinations should be confined to their households and not allowed to leave. Last month, 73% of Democrats still supported vaccine mandates for employment, right? If you are afraid that the government is going to program your digital currency to create a social credit system, I would say you've got pretty good basis for that. I believe that I've got a pretty good basis for that, right? There's a saying that goes around now, what's the difference between a conspiracy theory and reality? About 3 months, right? Which is, the point here is that yeah, it starts with the Nazis. It doesn't end with the Nazis. It started with the Nazis and Ann Coulter and Milo Yiannopoulos in college campuses. And with 6 months, George Will was being canceled, right? You could start with whoever you want to start with in the banking system, and pretty soon the truckers and Mike Lindell are being canceled, right? We've seen what's happened. We just, if you were in Senator Lee's talk, we've seen what's happened with the FBI, right? How the FBI has been weaponized. We've seen how the IRS has been weaponized. I think, in my opinion, to think that we can give this power to the federal government and expect that it will be used in a responsible way, in my opinion, that's just naive. Somebody who, I forgot another one. 49% of Democrats thought people should be fined and imprisoned for making statements on social media that question the efficacy of COVID vaccines. Do you really think these are people who would have any qualms about shutting off access to your bank account or trying to restrict your ability to spend money on certain things? To create a carbon credit system that monitored how many tanks of gas you bought, what your mileage in your car was, how many hamburgers you bought every month? I don't. I think if that's what these people are willing to do, I don't see any reason to think that they would have any qualms at all about this. We know people are losing their jobs. People are getting expelled from colleges for things that they are getting their acceptances retracted, right? This is just a rounding error compared to that. And so, unfortunately, in my view, there are a lot of interesting policy questions we should have here if we had a government that was subject to the rule of law and people who actually believed in that, right? But I don't think that's the world we live in today. In this world of the administrative state, where so much happens, I don't think there's any reason to believe that if they wanted to, the federal financial regulatory authorities today, I suspect, could probably do exactly what they did in Canada in terms of using all their vast powers to freeze your bank account or do whatever they wanted to do if they thought that you had done something wrong, right? We all know what they did with Operation Choke Point, a decade ago during the Obama administration. We all know what's been going on the last couple of years with the government leaning on social media companies. We all know what's going on right now with them leaning on banks with respect to ESG policies and the like, all of which is done in the shadows and all of which is done without most people actually knowing about it in sort of a regulation by raised eyebrow and that sort of thing. And so, unfortunately, I think that we are in the world of the current administrative state that does not resemble the rule of law in any meaningful way, and a large portion of the population who is willing to punish people for not going along with what they think they should go along with. I think that is a very volatile combination. And so, unfortunately, I think whether it's this, whether it's free speech on campus, whether it's cancel culture in banking, we are now being pushed into what economists would call corner solutions, which is, I think, unfortunately, in a world where we could have balanced, nuanced discussions and trust that government powers would be used responsibly. That's the world we want to live in. I don't think that's the world we live in, and I believe that of all the threats that are out there right now, central bank digital currency is the biggest possible threat to all of this. The ability to actually create what amounts to a social credit system where the government can abuse these powers, and as we saw during the financial crisis, and to some extent during the pandemic, the litigation system is reactive, it's slow. We saw this time and time and again with this administration. They would just do things and just dare the courts to eventually overrule them, right? And sometimes the courts would, and sometimes the courts would defer to it. So I don't see a lot of rule of law being introduced into to this system. So that's my very moderate and measured comments on central bank digital currency.
All right. Well, I told you that Professor Zywicki was planning to scare you. So let's hear some response. I think Professor Schwarcz would like to respond, and then we'll let Mr. Quarles speak as well.
I just want to put some of these concerns into perspective. Todd eloquently states the worst case, but the worst case won't even begin to come about unless you have the central bank extending credit directly or creating the accounts directly. And this goes back to the whole issue that Randy talked about of the so-called disintermediation, the harm or the hurt. And that is that you essentially, where you have a CBDC, you're going to siphon off, as a practical matter, a significant portion of what otherwise would go into bank deposits, into the CBDC, and thereby reduce essentially low-cost business funding. And one of the main solutions that the EU and others are considering, if you do have that hurt, is to then have the central bank make direct loans. And that direct loans, that introduces the concerns because you'd have the government making credit decisions. And I think everyone would agree that that is incredibly dangerous. But I just want to point out for perspective that if you have a system where you have the government actually delegate to the private sector this form of private ordering, then you're not going to have that disintermediation, and you certainly shouldn't have the need for the central bank to effectively step in and make the business loans. The other point I just want to point out, and to provide further perspective, is whatever we have in a CBDC, I expect that governments will become involved to some significant extent in stablecoins. As I mentioned, stablecoins are sponsored, well, they could be government sponsored, but they're likely to be private sector sponsored, like, with Libra and Diem and so forth, Facebook. And you're going to create the same potential disintermediation risk, and you could also create other types of risks that the governments will lose control to some extent over their monetary policy. And I suspect we will at some point see the evolution of more private-public partnerships, whereby private sector entities that sponsor stablecoins might well partner with governments, where the governments will essentially ensure the redemption rights in the stablecoins, effectively making the stablecoins the equivalent of bank-insured deposits. So that's another way governments can get involved, and I think that is probably less dangerous, although I'm sure Todd will counter that. Okay.
So I think, sorry, let me get close to the mic. So what Professor Schwarcz is describing would avoid at least one of what I think is the major systemic problem with the central bank digital currency, but it would also miss what really is the desired result of many people who are arguing for a central bank digital currency. So we've all talked about our currency is already highly digitized. So what is the benefit of moving to a different form of digitization? Well, it could improve cross-border transfers. Transfers within the domestic financial system are already pretty efficient. Some people like to complain about the cost. The cost is generally not particularly, various solutions to that don't really change the cost to the consumer, and consumers aren't really complaining about it. People are basically happy with the domestic transfer system. International transfer system, it could possibly improve that. But the developments that are happening in the private sector with private sector payments technology are on track to solve that. You don't need a CBDC to solve these issues. That technology currently exists and is happening in the private sector. You can regulate that without competing with it by creating a CBDC. People, the coalition around a CBDC is of those who want other things than a CBDC. They want a bigger government footprint in the allocation of credit. That is a significant reason why the progressive side of the political spectrum is heavily, almost universally in favor of a CBDC. It is not because they want us to be able to pay for our Danish in the morning on our phone. It is because they want the consequence of disintermediating the private sector banking system, ideally totally, for the Federal Reserve to begin making credit allocation decisions as much as that can be done. That is the political impetus on that side of the spectrum for this. On the other side of the political spectrum, there are those with national security concerns who say we are being outcompeted by China and must do this to compete with China. That is a misunderstanding of what causes the dollar's value and how the mechanism of digitizing the dollar would affect that. It would affect it almost not at all. The Chinese are developing their state-sponsored digital currency to increase their ability to surveil and control their people. That is not something that's going to make their currency more attractive relative to the dollar. But it is something that would make a Federal Reserve central bank digital currency more attractive to certain folks within our domestic system. So I might not speak quite as passionately as Professor Zywicki about the risks, but that's the political dynamic that's going on here. Now, I should say, Judge Larsen mentioned at the outset that I think that a central bank digital currency actually is unlikely in the United States. And I think that is because of an accident of history. The Federal Reserve Act has certain provisions in it that I think can't be satisfied currently for a currency-like instrument unless it is printed. There are certain provisions that basically require that a currency instrument issued by the Fed have certain things printed on the front of it. You can't do that if the thing isn't printed. Now, that may be a barbarous relic in the 21st century, but it remains the law. It is the best view of the Fed lawyers, although not necessarily the Fed as an institution, that the Federal Reserve Act would have to be amended for the Federal Reserve to issue a central bank digital currency, which means that the Congress would have to get together and think, think about this, have all these arguments presented to it. And I think when that actually happens, the Congress would ultimately, you would not be able to get 60 votes in the Senate for a central bank digital currency. And that's why I think that in the United States, it's actually unlikely. But because of this odd collection, because of the strange bedfellows that have been created by the politics, you've got conservative national security types wanting to protect against China and extreme progressives who want the government to have a bigger footprint in the financial system, you could end up with a majority actually supporting a congressional action in favor of digital currency, which is why I think that it's important that we have these sorts of discussions so that people understand what's really at stake.
Yeah, I'll just echo that. That's my concern. That's why I start off by saying I'm afraid it's inevitable from a political perspective, which is you have the central bankers, right, and the bureaucracy pushing for it because it increases their power, and they say, well, now we can manipulate the economy better, right? We don't have all these lags on monetary policy. And again, I mean, obviously Powell made a complete disaster out of, this is why we have inflation, right? Larry Summers tried to explain that you got to stop like doing so much, right? And they wouldn't listen, and now we got inflation, right? The Fed has failed over and over and over again. It's just central planning. Central planning doesn't work, and giving them more tools to engage in central planning isn't going to work, but they'll keep pushing for it, right? Then you get, as Randy said, then you get the progressives, right? The first thing that Rashida Tlaib focused on when she got elected to Congress was bringing cryptocurrency and the like into the banking system. Why? So they could have visibility, right? Which really means control over crypto, right? Everything that libertarians, conservatives see as the frontier of freedom to escape the state, they see it also, folks. I mean, if it's obvious to us, it's obvious to them, and they just don't think it's a good thing, right? They're always on top of this, and this is why they've shifted tactics from Operation Choke Point to the more subtle things that they've started doing subsequently with respect to cancel culture, with respect to the way they've leaned on the social media companies and that sort of stuff, to go right up to the line of state action, right? And basically say, oh, no, we're not going over, right? So you got that control. And then my concern is as Randy says, the Republicans who see it as a China national security thing or see the benefits in terms of preventing crime and this sort of stuff. And all that lacks is a crisis, right? And if we have a crisis where they say, okay, we're going to introduce this cryptocurrency, we're going to get people's $1,200 stimulus checks, all they have to do is open an account, right? Or they say, we want to stimulate the economy, so we're going to give it to you, but you have to spend it in the next 3 months. So it's going to be programmed to expire in 3 months because we want to stimulate the economy. That's how it starts, right? All of these things start with a crisis, and then after the crisis, you never put the genie back in the bottle. Just look at what happened with Dodd-Frank, right? And so yeah, my reading of the law is the same as Randy's, which is it doesn't look to me like they have authority to be able to issue this stuff. It also didn't look to me like the Fed had authority to give to do what they did with the banks during 2008. And certainly, there was no authority to do what they did with Chrysler and General Motors during 2008. And a lot of good that did, that was all illegal activity, right? And so the way, in my view, what I fear is the way this lurches forward are these crises where these things happen, the government seizes power, and it never goes back, right? And that's the way in which I fear that this gets extended, which is they take what is arguably an illegal activity based on a strained interpretation of the Federal Reserve Act, and who's going to challenge it? How are they going to challenge it? Who has standing to challenge it? When do they challenge it? When does it get resolved, right? And by that time, I'm afraid it's done. Now, I know I sound like I know I sound paranoid up here, right? But I have seen this happen with cancel culture in banking. I've seen this happen on campuses. I've seen this happen in employment, right? Where the screw just turns, right? It ratchets, it pushes. And this just seems to me, I don't see any reason why this is different from anything we've seen in any of those other areas when it comes to the kind of concerns that I'm expressing. Maybe there's a difference there, but I don't see it.
All right.
Sorry.
So I see we're starting to have people line up for questions, which is great, but I know Professor Schwartz wants to respond, so I'm going to give him a chance to do that, and then we'll move to the audience question.
Yeah, I just want to very quickly respond that the point that Randy and Todd make about the Federal Reserve Act, that would be correct. It could be a problem if we're talking about a CBDC that were a direct liability of the Federal Reserve. But again, under the private ordering type arrangement, under expanding, for example, Article 4A of the UCC to retail payments, you would not have a CBDC as a liability of the Fed. It would simply be a way of transferring electronically, digitally, the same good old green dollars we currently have.
I'm going to ask a clarifying question. I'm going to jump in as a point of, moderator privilege. So what I understand you saying, Professor Schwartz, is we can avoid Professor Zywicki's doom and gloom through this sort of moderating system. But then I hear Randy saying, yeah, but then there's no need to do it at all. Is that right? Is that where we are?
Well,
what is the answer to that?
I think part of this, is always a question of reality and appearance. I think that I know there's a lot of pressure to have something that purports to be a CBDC and that can enable retail payments to be made digitally, okay? Now, there are other mechanisms that can be done, but I think this approach by expanding, the wholesale payments to the retail payments would be a very straightforward, a very simple result. You'd have to graph on strengthen privacy laws. You have to do some changing to the Know Your Customer laws and consumer protection, but all those can easily be done. So I'm suggesting this as a practical compromise that at the very least will give the appearance of having a CBDC and will not have the harms associated with what Todd is describing or what Randy is describing.
Yeah, well, I would certainly say that, I've had a few different stints in public service, and the solution of we need to find some way to appear to be doing something without actually doing anything is time-honored and very respectable. So I wouldn't necessarily object to that if we found ourselves in a situation where we had to appear to be doing something. I'm hopeful that we don't.
All right. We have time for some questions from the audience. I'm going to ask that when you come to the microphone, you state your name and any affiliation you want to give. I'm also going to ask that you ask a question. And with that, this gentleman has been standing here for a while.
Thank you. My name is Bert Ely, and I'm a member of the Financial Services Practice Group here at the Federalist Society. A comment and a question. The comment is, if China thinks this is a great idea, that alone should be enough of an indication that we don't want to do it in this country. My question for the panel, and maybe specifically to Professor Schwarcz, is, have you seen anybody come up with a proposal laid out in detail that will in fact address the concerns that Todd in particular expressed? Number one, the ability of a central bank digital currency to be used for, number one, credit allocation purposes, and perhaps more perniciously to be used for surveillance.
I haven't seen anything systematically that addresses that other than, to some limited extent, a law review article that I published a few months ago in the Boston University Law Review. I know that there's a great deal of concern in the EU about their surveillance, and they're still, trying to, get their act together. They haven't decided.
All right, we will go to the left, I guess your right microphone.
Coach Winehouse from UCLA, taught cryptocurrency at University of Chicago Booth and doing research at WashU and monetary sovereignty. I advised the House Financial Services Committee majority staff regarding Libra, but more importantly, my company primarily managed the transition to Bitcoin as legal tender in El Salvador, the only country to do it. Assuming for the purposes of this question that Professor Schwarcz is incorrect about cryptocurrency's attractiveness to other countries, what issues for the U.S. dollar's position as the world's reserve currency, assuming that more and more countries use a consensus-based coin like Bitcoin to replace, as Vice Chairman Quarles dubs, the crappy international system for transfers?
So I think over time, if you were to have a, if you were to have a private payment system evolve that could, where there was a significant amount of trust that developed in an alternative, in a private alternative to the dollar that wasn't dollar denominated, obviously over time the role of the dollar as a global reserve currency is based on a lot of things, but one of those things, particularly over the course of the last couple of decades, as other bases of the dollar's dominance have eroded, has been its absolute dominance in use for international payments and financial transfers generally. And that would be eroded in that hypothetical. It's one of the reasons why I think, I don't think that is I don't dismiss that concern. I think we're a long ways away from it. The dollar will be the dominant currency of the world, even in the face of private alternatives like Bitcoin, and certainly in the face of other state alternatives for the rest of my lifetime. That's shorter than it used to be, but probably for the rest of the lifetimes of everyone in this room. But over time, that could certainly happen. It's one of the reasons why I believe that the U.S. national interest, the national response, should be to create a regulatory framework that supports, as opposed to tries to suppress, these private sector currency and payment innovations and developments. They are extremely useful. We can today solve the problem of the fact that the maid who's working at a Quality Inn in Las Cruces, New Mexico, and trying to send money back to her family has to pay a huge chunk of that to Western Union. That can be solved today through the private sector. It doesn't need a CBDC. It doesn't need anything. That could be done today if we simply accelerate the creation of a framework that supports these sorts of alternatives. And that's the U.S.'s that has always been the U.S.'s competitive edge. It hasn't been the competitive edge of our government in these issues. The dollar is the dominant currency principally because of the activities of our private sector and the confidence in our private sector. So, so my view is that we should be responding. We should be responding by, getting off of our tails on creating a useful regulatory framework around these private currencies, as opposed to trying to create an alternative that will compete them away.
Yeah, I want to echo that. When I was on both creating a framework for encouraging and making it easier to do these things like money transfers and stuff like that, the amount of time it's taken to move to anything resembling real-time payments is just mind-boggling, right? That doesn't seem like it should be that hard of a problem to solve, to get so that a check doesn't take 3 days to, right? And this has all kind of implications for overdraft and payday loans and all kind of terrible things because of the slowness of our system. And so this involves both a better regulatory framework and backbone for that, but also getting rid of bad regulations, right? When I was on the CFPB task force, just trying to find out what the impact of anti-money laundering laws and all these things that banks do that seem to be cost with basically no benefits. Nobody has any idea how much this really costs, except that it's a lot. It doesn't seem to do much, right? So regulatory reform could solve a lot of these things. And the larger problem is one, and I think I saw Randy say this in an article, so I don't want to steal from, I'll give him credit to it. This looks like a solution in search of a problem. Did you say that? Yes, right. So, right, because, and I will also say, it's not clear to me, you can be against CBDC without being an enthusiast of crypto, right? I'm not sold on crypto myself. That also looks like a solution in search of a problem for me when it comes to consumers. When we've got, Stanley would say, we just need better payments, right? Using the ordinary things that we have. Now, another observation, I'll be interested in your comments on this, Randy. The question was about the dollar as the reserve currency, and I've felt a little squeamish as inflation has returned and instability. One of the scenarios I've heard, and I'd be interested in your response, would be the concern about some sort of commodities-backed currency issuing from, Russia, China, Iran, an oil, metals, sort of commodities-backed a currency that could become a global reserve currency that would have much more stability because it would be tied to a basket of commodities. Is that a realistic concern, do you think? Or a realistic scenario? I shouldn't necessarily say concern, but scenario.
I don't think so. Obviously, China and Russia less in tandem than they were a year ago, but they're considering trying to create an alternative, an alternative system, if you will, an alternative sort of macro monetary regime. It's just it's a lot more than just our monetary policy that is the basis for the dollar's attractiveness. It is fundamentally, it's too long of a story, so there are too many people waiting to ask questions, so I won't tell the whole story, but the world arranged itself at one point so that I was in the office of the finance minister of the UAE, of the central bank of the UAE in Abu Dhabi, sort of apologizing to him for something the United States has done and telling him that we really did want him to continue buying Treasury securities. And because he'd made some statements that he was going to stop. And he said, I just said that for public consumption. He said, I suppose I could buy euros, and what would I do with them? Invest in Italy? The dollar is a dominant currency because people have no better option of where to put their investment assets than in the United States, and that is not going to change for a long period of time, and they certainly won't prefer to put their investment assets in Russia or China over the course of the next 20 years.
Okay, I will move to this gentleman on my right, your left.
My name is Rad Yurovich. I'm a student chapter president from University of Illinois. And I wanted to get back towards the environmental aspect. And just recently, the EU created the Sustainability Directive. I forgot its full name. And there's other movements to use environmental scores and stuff like that. And I'm wondering, do you see there being sort of a way for companies to say, okay, no, we don't want to do business in the EU because of all of this? Or is just the global economy too interconnected that just one country can dictate the standard and companies are just going to say, well, too bad, I have to live with that?
Who wants to take that?
Anyone want to take that question?
You know, the whole issue of sustainability and all this is very mushy, so to speak. I'm actually giving a talk tomorrow morning at 6:35 a.m. At the World Sustainability Conference. And my talk, I've looked at the other talks, I think my talk is the only one that will be concrete in any way. It's just, that's all I can say.
For a large international, globally active company, I don't think that there's an alternative. That's just, the EU will set its standards, and that will drive the standards that they have to comply with, and if they have to comply with them in the EU, that will tend to, drive their activities in other parts of the world. But a huge part of our economy and of the global economy is not conducted by gigantic multinational corporations. A huge part of it is conducted by smaller companies that are principally domestically focused, or if they sell internationally, sell in such a way that they fall below thresholds for some of these issues. And we can do a lot to maintain that dynamism by ensuring that our rules remain sensible.
Okay, I think we'll go over here to my left.
I think that there is a way to do this, perhaps, that would resolve some of the concerns that Todd raises. In my mind, it's possible to create a cryptocurrency like Bitcoin, but a new one, something else, that the Federal Reserve would then promise to peg to the dollar. It would offer to exchange dollars with this digital currency at a one-to-one rate. But it's important that the ledger for that currency is held in private hands, distributed, such that the government can't transfer, reduce, or change that, and that the transfer occurs entirely privately, so that it's not the government that can manipulate that process. Now, the tricky part then is the rules around when new currency is created, because that could be manipulated both by government or private parties. And so in my mind, it would have to have a two-part process where it would be something that would be proposed and accepted by the miners or the transfers, the private parties that are managing the system, and then also some type of veto gate where the Federal Reserve could veto changes to the system in printing money, so that their own ability to buy and sell this digital asset to ensure that it is fixed at the rate of $1 could not be manipulated to basically grab lots of money from the Federal Reserve. So I was wondering what your thoughts were on both the ability for this to solve Todd's problems, as well as create a digital currency that would actually be pegged.
Let me just very quickly, and then what you're suggesting is similar, I think, to the idea of the private sector sponsored stablecoin with the effective government guarantee, making it the equivalent of like a government-backed bank account. I do cover that issue. If you're interested, there's a paper coming out, 75 Vanderbilt Law Review, in any day now, that will go through a lot of those details. And if you want a cite, just email me at Duke.
But I'm not talking about a single private sector person managing the coin. I'm talking about a distributed system where it's held by thousands of different individuals, similar to Bitcoin is, in a way that can't be manipulated in that.
Yeah, and that's different. I mean, the stable coins would be protected by cryptography, and how you design the cryptography would depend. You're talking about the distributed ledger technology of Bitcoin, and that is a good thing. That's not necessarily the only cryptography.
In many ways, the question Judge Larsen asked, which is, the feature is the bug, right? The argument, fundamental, I mean, yes, clearances between banks and that sort of thing, neato, right? Keen, right? We can probably figure that out by blockchain, right? But the feature is the bug. The reason people want this is precisely because of control, right? The reason people want this is so that they can manipulate the currency and use negative interest rates so that they can program it to provide better stimulus payments, so they can deposit it, via government stimulus checks, so that you can get visibility into terrorist bank accounts and that sort of thing, right? Otherwise, yes, you could do what you're saying, Devin, fine, right? But that's not why they want it, right? That's kind of, okay, maybe that helps, right? But now it seems like we're back into the world of that problem seems like it's kind of solved already. And so the whole rationale for it is the control, right? They think that it's good control, right? But that's my sense of why they want it. And you can find all kind of quotes all over the internet from these people talking about the ability, to control spending and manipulate the economy and that sort of thing. And so we can do workarounds, but it seems to me that maybe that's helpful in some way, but it seems like a pretty marginal improvement over what we already have. So, my view.
right.
Roberts of BlackRock in New York. Gentlemen, do you have similar concerns regarding government surveillance and government overreach in connection with tokenization of other asset classes like treasuries or money market funds or sec lending and so forth?
So I don't really at the same level. The issue with respect to, for me, the issues with respect to the tokenization of money are different than the tokenization of a lot of assets. In part, because all of the transactions, all of the financial transactions that you use could be used for surveillance because of the issues about the effect on the existing banking system. And I think all of those are sort of sui generis to the tokenization of money and present themselves much less in the tokenization of other assets. And I think the cost-benefit calculus is much different in the tokenization of other assets, both other financial assets and other types of governmental assets like government records.
Yeah, I think that's right. And, I've argued that there are probably things we could probably do with respect to our existing regulatory system that would protect people more. So I floated the idea of Brian Brooks's, proposal for the Fair Access to Financial Services rule, right? That would eliminate the ability to cancel bank accounts based on ideological and political beliefs like we see going on here. I guess I can ask another pop quiz. Everybody knows what PayPal did, right, with their misinformation policy. How many people in this room believe that was just a mistake? Right? I mean, come on, who are they kidding, right? And so I think that there are things with respect to payment system, bank accounts, sort of the basic infrastructure and plumbing of the financial system that people need and can be leveraged for nefarious purposes by both public and private entities that we should be thinking more about how we deal with that.
Thank you.
Okay, let's take this gentleman right here.
Hello, good afternoon. Michael Collins. I've got a two-part security question. Part one, current tokens are based on like you create new, or there's a resource cap on creating new tokens. The Fed obviously isn't going to agree to that. So without that, how do we prevent just digital counterfeiting running rampant? And second, current tokens are verified on distributed peer-to-peer networks on the theory that no one person could take over enough nodes to affect the verification, but a nation state, which would have an incentive to undermine a national bank's currency, could. How do we protect such a currency from those threats?
Interesting question. Either of you want to take that?
Well, I think so that highlights an issue that that I think is very important, but that I haven't mentioned in my comments and that we haven't really talked about in the comments here, was just the technological challenge of creating a state-backed digital currency because of the target that it becomes for, particularly for other states. And there's a tendency, even among those who are skeptical of the federal government and the Federal Reserve, nonetheless, to believe in its cosmic power. And, once you've spent some time inside of it, you sort of go home in the evening saying, is that all there is? So it's absolutely not, a mere technical or execution question as to the, just the pure technological challenge of creating this. I think it may be beyond the ability of the Federal Reserve to create a national digital currency that is unhackable, given the target that it would become, whereas the various private currencies are distributed and fragmented enough, and all the benefits of distribution that are at the basis of this technology to begin with, that you'd lose if you tried to centralize it in a state.
Yeah, that's a great point, and one that I hadn't thought that much about, but, I basically have personal credit monitoring for life because both the OPM and IRS hacks of my personal information. And I often joke, of all the institutions in American society, probably the one I would trust least with my Social Security number is the IRS, right? But it's a good point, right? It's an unbelievable trove, and you just think about the target for hacking and this and what that could do to the economy if they actually were able to break through, which they will. So that'd be a big ransomware payoff.
Yeah. All right, here on my right.
Hi, my name's Tristan Honeybourne. I am here from London in the UK. I've worked a bit on cryptocurrency through my work. I'm also the Vice Chair of Research at a group called the Society of Conservative Lawyers. We're affiliated with the Conservative Party back home. I can assure you it's now much easier to transfer money from England to Paris, thanks to the private sector and fintech companies. And that's a very good thing to see. It's certainly much better than it was a few years ago. So my question, it's been touched on just toward the end of some of your comments, is on foreign policy. And you talked a bit about how this whole process might be used defensively as a shield against China to preserve the status of the US dollar. I'm interested also in how this can be used as a sword, because, so a few months ago I was in Zimbabwe. Zimbabwe only used the US dollar. It's a rogue state. The reason why they use cash dollars is because they're frozen out of the international banking system. But the question in my mind is whether use of Federal Reserve-backed dollars could help impose sanctions, whether it's Russia, China, Zimbabwe, elsewhere, against rogue states, and really fulfill an important international responsibility in that area. So I just wondered what you think about that.
Well, I think you would. Yeah, it gets to an interesting question about the nature and use and demand for the physical dollars currently. I think you'd only be able, a digital currency, whether state-sponsored or sort of a state-backed regulatory framework to encourage the development of a private digital currency, would obviously only be able to be sort of solve the sanctioning issues outside of the United States if you stopped producing the physical dollar. So what most people, and that has not to date been on anyone's agenda. Any of the central banks that are proposing to issue digital currencies have not said that they will stop producing paper currencies. There are a lot of reasons for that, including the actual financial inclusion reason. I mean, people say that digital currencies are supposed to be financial inclusion, but it's really hard to understand how that's supposed to be financially inclusive, because now, in addition to some sort of a bank account, you need a cell phone, and you need cell service, and you need Wi-Fi and broadband, and and if you're in a rural area, you can't get any of those. So countries are not going to stop producing their physical currency. It may not be widely known that the great majority of physical currency that the United States produces is held outside the United States. And I used to joke that it was largely in the mattresses of Russian oligarchs. And that demand has increased at about a 45-degree angle for most of our lifetimes. Even as most of us are using less and less cash, the world uses more and more dollar bills. It's not usually for bad purposes, though. If you are a businessman in Jakarta headed to Kuala Lumpur, you could convert your rupiahs into ringgits so that you can buy something for breakfast at the little shop next to your hotel that doesn't take a credit card. But it will be easiest for you to bring some dollars, which is what most people do. And so that demand for dollars is still out there, and unless the Federal Reserve said we're going to stop producing a physical dollar in order to satisfy that demand, people would just buy more dollars, and the digital currency would not really be helpful in that regard.
Yeah, the international questions on this are interesting to me. I've become aware of an experiment with this in Nigeria recently. Nigeria moved to try to introduce a dollar there, a central bank digital currency there. They bribed people, they cajoled them, and the Nigerians have completely rejected it, partly because apparently they use a lot of like Bitcoin and crypto and that sort of thing. But the main reason is that the Nigerian government is corrupt, and people understand that the real reason they want to do it is to control them. And in fact, it turns out, as I looked into this, the playbook for what Trudeau did was actually what Nigeria did in 2000 or 2020. Before like the pandemic in Nigeria, there were anti-government protesters in Nigeria against their corrupt regime, and the government just froze all their bank accounts. And they managed to switch over there to using greater Bitcoin and to evade it and that sort of thing. But we'd always hoped, I guess, that the rest of the world was going to become more like the West. But apparently now the West is becoming more like the rest of the world. So,
thank you very much. If I can just make one point briefly. So when I imagine a state-backed digital currency, I envisage the interest is paid by default or applied by default at the Federal Reserve rates. And so you could embed into the system a cost to continuing to use cash, because if people hold their dollar bills, they will not receive interest on that. And if you're, whatever interest rates are now, if you're foregoing that interest, you can see a very interesting argument there why countries might prefer to hold the crypto assets rather than the physical. Thank you.
All right.
Thanks. Brian Bishop, the Stephen Hopkins Center for Civil Rights. And my thunder was stolen by somebody who has direct experience in Europe. But when you mentioned, like, one of the efficiency issues was transfers between countries, it just occurred to me to ask, don't they have Walmarts there? I mean, that's the easiest way to move money in this country. I bought a car for $3,500 and I sent the money to myself at a Walmart, so I didn't have to have somebody ask me when I got on the plane, why did I have $3,500? Yeah, right. So we have, I think the efficiency justification is really fading, which gives me the concern that the justification is in fact what Professor Zywicki suggests.
And that's a good example of what I'm talking about, is to the extent that we still do have problems with financial inclusion and things like that, the answer is more competition. Right? It's industrial loan companies. Walmart wanted to become a full-fledged bank, and the incumbent banks kept it from happening, right? But where Walmart has now entered into things like money transfers and that sort of thing, they have totally driven down the prices, right? Western Union has been forced to slash their prices to keep up with the fact that Walmart, when they enters the markets, they do what they do to every other market, right? And so, the left, their dream is postal banking for some reason, right? Like, they can't even deliver the mail, but now they're going to be able to be a bank, right? But the answer is, more competition, more choice for consumers, and Walmart's good at this. Let them do it, right? And so that's why I say, echoing Randy's point, it's not just creating a better regulatory framework to allow this stuff to happen, but clearing away existing regulatory barriers that are just entrenched by rent-seeking and special interests.
All right. If there are no more questions, do either of you want to make any closing remarks, or are we
Everything may have been said.
All right, well, thank you very much to our panel. Also, thank you to Professor Schwarcz in absentia for his remarks as well. So thank you for coming.